Hey, welcome to GRE. I'm your host, Keith Weinhold, answering your listener questions this week. Why exactly are house prices soaring nationally? I've got 10 big reasons for this. Are interest-only loans worthwhile? Is this year the right time to buy property? And for the first time, you'll meet a member of Team GRE that helps you find specific markets and property addresses for investment today on Get Rich Education. For accredited investors, if you've ever dreamed about making 10 to 12% of passive income annually, Wagner and Alasko and his partners of professional syndicators have the answer for you. Invest in one of the safest assets available on the planet, real estate. On a preferred return basis, you will collect your money before anyone else does. To find out more about these opportunities, visit I'mAccredited.com or text 305-684-2222 for your free investment guide. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. With now more than 4 million listener downloads, you're listening to one of America's longest running and most listened to shows on real estate investing with minors in economics and wealth mindset. I'm your host, Keith Weinhold, whipping around the asset classes before we get into why home prices are soaring. You know we do this at end of quarter at times. Stocks had their first losing quarter in 2 years. In Q1, the S&P 500 was down 5%. The 10-year T-note yield was up 0.9%. Bitcoin was down 1% in the first quarter. Gold was up 5% and oil was up 32%. I'll talk about real estate's upward price movement later. Let me address some of your more pressing listener questions this week. It's been a while since I've fielded listener questions. Roberta from Rock Hill, South Carolina asks, why are home prices rising so fast? I'm just trying to put together a 20% down payment to buy my first property, but the prices keep rising faster than I can save. Yeah, thanks for the great question, Roberta. So many people have that question, and you can make as little as a 3% down payment on an owner-occupied home, by the way. But on the soaring home prices, I've got 10 reasons about why this is happening, and I'd like to think that this is the most complete answer that you're going to hear anywhere. Yeah, there are 10 reasons why home prices are appreciating faster than average. Altos research just informed us that the U.S. median home price crossed $400,000 for the first time. A total milestone there. They've risen in price close to 20% annually. Homes are now selling 3 times faster than they were pre-pandemic. Now, none of these 10 reasons is population growth. Yeah, that's been pretty slow overall based on the census numbers. The first reason for surging home prices is millennials. Yeah, contrary to what some believe, millennials buy homes. I mean, they really buy homes. In fact, they're a whopping 43% of home buyers. That is the biggest group by far. And let me tell you about why this really matters. But first, they're commonly defined as that age group born from 1980 to 1998. So that makes them about age 24 to 42. And some demographers disagree on those marks, but it's somewhere around those ages. And they're also the largest generation in American history. Now, within millennials, the most populous age cohorts of any age cohort is age 25 to 34. That's where the biggest group of Americans are in age. So what that really means is a lot of them are just aging in to becoming first-time home buyers. A big group of people just aging in to their household formation years, whether they buy or they rent. The second reason is safety. You might be thinking, safety, what does that have to do with surging prices. Well, this is one of those longer term, longer tail trends that has been building up for decades. Look, when it comes to home building, safety around the house, a prudent level of safety is definitely a good thing. But with all this buildup over time, safety compliance in places, it has almost reached onerous levels. I mean, you need GFCI outlets and more railings, and sometimes your water heater needs these restraining straps put around them. And you need to have carbon monoxide detectors on the ceiling. And, is there a furnace behind that door over there? Well, if there is, you're going to need a pricier, thicker, fire-rated door, even if that furnace is 20 feet away from that door in a garage with concrete floors. All of this safety, some of which think is becoming excessive, well, that adds expense and complexity and time with the labor to home building and to renovations too. Well, because this raises costs to build all levels of housing, this sets a higher bar for affording an entry-level home. That increases homelessness. Safety standards rarely relax, they only constrict. The third reason home prices are surging is pandemic, what I call the space race, that race for space. Starting in 2020, the virus made people want to move to the suburbs for elbow room. A lot of people began to avoid densely populated neighborhoods. So people were really spreading out. And sure, we all know there was an acceleration in the work from home trend, but increasingly also more people are spending time at home than before to exercise on their Peloton bicycle or garden at home or greenhouse at home or homeschool increasingly. And look, when you're doing almost everything from home, you sure are willing to pay more for a home. You want to move around and get that situation just right, and you're willing to pay more. And the other thing in a pandemic is that families often stayed intact. For those people in roommate situations, again, millennials are the biggest group, those roommate situations didn't work so well in a pandemic. So when two roommates that previously shared a home together, when they split and each got their own home, now you have two people occupying two homes rather than two people occupying one. Well, demand just doubled right there. And now a lot of people are deciding long-term that, hey, I kind of like living alone. The fourth reason that home prices are soaring are material shortages. I separated this out from the pandemic because there are some other forces here. Sometimes home builders, they have to leave homes 95% finished, even 99% finished, as they just wait on a garage door or cabinets or other fixtures. So an unfinished home, that increases builders' carrying costs. It's just that much longer that they have to pay on loans and everything else. So supply chain disruptions slow down these builders. So that introduces uncertainty, making some delay building at all. And when builders do decide to build, they need to price in that risk and pass it on to home buyers. The next reason is inflation nation. Come on, I've talked about this on the show a lot. Is inflation like the only thing still made in the United States or what? This pushes up prices for all of buildings' individual components, from lumber to copper to cabinets to drywall. And you know what? It's funny. A lot of the same people that wanted to be paid to stay at home and get stimulus checks and get $15 minimum wage and have business shutdowns, a lot of those people that wanted that are the same people that now complain about inflation. These are the very things that help produce inflation. And the 8% government inflation reading, that still doesn't even have the war in Eastern Europe factored into it. The sixth reason is regulation. Yeah, increasing regulation. And this is one of those long tail trends over the decades, a lot like safety is. More restrictive building regulations just keep mounting. Zoning compliance, permit requirements, neighborhood restrictions, NIMBYism, population density laws. All of these things just pile on top of each other, and they conspire to limit new building. And this increases the land cost as well, the cost of the land that the structure is built on. The next reason for surging home prices, and why they've pushed up so much in the past year and a half or more now, is low interest rates. Yeah, they've risen from their January of 2021 all-time low, but interest rates are still historically so low. And rising rates, they're also an incentive for buyers to want to lock in sooner and get into the real estate market. And what higher rates do to existing homeowners, people that already have that home, is it sort of prevents them from listing that home because they would lose their low rate if they would list that home. So when homes are not put on the market, this further constrains supply. Rather than list that home, they're either going to stay there a lot of times, or they might hold on to it and move into another home and keep that low rate as a rental. Increasing mortgage rates likely mean that even higher housing prices are coming, not lower ones. Almost everyone thinks the opposite. I explained that phenomenon here on previous shows. I needed to bring that up again in order to get this entire package of 10 reasons as to why home prices are surging. But yeah, mortgage rates, they have a lot less to do with house prices than most people think. Just look at history. And the short story as to why that happens is because rising rates confirm the economy is strong by conventional measures. I have talked about that extensively. And you know something? Saying that for a while here, I felt like real estate's sole mortgage rate iconoclast until recently when the New York Times published a piece corroborating what I've been saying since last year about how higher mortgage rates actually mean higher prices. The eighth reason for surging home prices is equity. Homeowners hold record amounts of equity today. Now, what would high equity positions have to do with soaring home prices? Well, if homeowners do want to move, more of them can pay all cash. And these all cash buyers, that's how they can roll over these wannabe first-time home buyers that are just trying to patch together a down payment. And see, here's what happens. An all cash offer that does not need an appraisal, that does not need a mortgage, so they don't care where mortgage rates are. And if you don't need an appraisal, you can pay any amount that you want to. And interestingly, the national loan-to-value ratio is so low right now. It is the lowest it's been in decades. Can you believe this? Get this. The national loan-to-value ratio is 31%, meaning they have 69% equity in the property. I mean, sheesh, a lot of people have not learned to optimize leverage. That's one thing that tells you. But millennials want to buy. Boomers are the ones that hold the wealth. They hold that equity. The ninth reason, it's another one I've discussed before, keep your eye on the supply. It is that low housing supply. You know, after the 2008 to 2010, 2011, that global financial crisis, housing was oversupplied. And when that occurred, many contractors left that trade completely. Nothing else needed to be built. Well, now there still aren't enough skilled tradespeople to build homes, and this ensures a lengthy housing inventory shortage. We're just not going to pop out of this undersupplied housing condition like next year or something like that. We need about a 400% housing supply increase just to meet demand, and there's still no inventory growth. Incredibly, that whole phenomenon is even worse for entry-level homes. And really, here's what happens. When just two bidders, they go bid on one listed home, well, the top bid, it might not exceed the asking price. But at 20 bidders to one home, because supply is so low, that top bid is going to continue to exceed the asking price. And that right there is the direct mechanism that drives prices higher. The 10th and final reason is affordability. And although affordability keeps diminishing, and I believe it will worsen further, affordability is still better than most people think. Due to higher incomes and lower mortgage rates, real house buying power adjusted prices are still 29% below their 2006 peak. And the source here is First American's Real House Price Index. So those are the big 10 reasons about why home prices are soaring. Roberta, I hope that that's helpful. And home price growth, that's going to be most vulnerable on, I think, two major emergent trends, at least two of them. Higher supply, like I said, the supply of homes is inelastic. It's not going to increase markedly anytime soon. But that second one is when affordability just becomes too low. And I think really that's the major Achilles heel when this appreciation slows. It's because affordability becomes too low. And of course, everything I've talked about here, with that context, one needs to keep in mind is that real estate is local. I've been talking on the national level. And understand, with some context, when it comes to other nations, like if you're a listener in a different developed country like Canada or Australia, you must be thinking, What high American housing prices are you even talking about? Americans pay substantially less for real estate than those nations do. Plus, we get the 30-year fixed rate mortgages as well. That's a benefit that, for example, Canadians just don't have. Before I answer the next question about interest-only loans, if you'd like your listener question answered on air, you can do that in a few different ways. Go to getricheducation.com/contact. That's where you can leave a voicemail so that if I select your question, I can play your voice on the air with your question, or you can write in at info@getricheducation.com. And a third way, in an increasing way, we get more listener or I guess viewer questions is on our Get Rich Education YouTube channel. So you might ask a question in the comments section of a video over there. And by the way, I'm still wondering why this podcast that you're listening to right now is so much more popular than our YouTube channel. Is that because my face is not as good to look at as my voice is to hear? Is that what's taking place over there on Get Rich Education YouTube? I will try not to take that personally. I'd like to think that it's only because we got serious about giving you more YouTube content starting just last year. And this show, the GRE podcast, has been on the air for 7.5 years now. Speaking of which, Antonio, over on our YouTube channel, he wrote in, "Always such good information. Thank you. I wanted to ask you, is an interest-only mortgage a good way to go for a first-time investor?" All right, thanks for that brief question, Antonio. Now, you, the listener, you might have thought the same thing about interest-only loans that I did the first time that I ever heard about them. It was something like, "Are you nuts? Interest only? How would I ever get the property paid off if every month I only pay toward the interest and nothing toward principal?" Well, Antonio, in a lot of cases, interest-only loans are the way to go. In fact, it might be my very favorite loan type. And now the short story is, why would you pay anything toward principal if you have the option not to? That's how I think of it. Home equity is unsafe. It's illiquid, and its rate of return is always zero. So therefore, why would anyone build up that equity faster? So that is the short answer. Now, let me use an example with some real dollar figures to show you what I'm talking about. And this is going to be generalized because interest-only loans take somewhat different forms over the years. And I have had interest-only loans before myself. In fact, I've had one on a fourplex. Let's say that you have a standard 30-year fixed amortizing loan, and that payment is $1,300 a month. $300 of that goes toward principal, and $1,000 toward interest. Or instead of that, you could get an interest-only loan, meaning that your payment now drops to just $1,000 a month. It all goes toward interest and zero toward principal. All right, so what have you just done by using that interest-only loan instead of an amortizing loan? You just reduced your principal paydown by $300 and you increased your cash flow by $300. Now that right there is a good trade for almost anybody. So another way to say it, Antonio, is that your monthly payment money that would have gone to principal instead increases your cash flow dollar per dollar. So every month you get to effectively transfer your equity into cash flow. And there you go. That is the financial freedom formula, transferring equity into cash flow. People become financially free when they successfully do enough of that over and over again, turning equity into cash flow. And you're doing that every single month with the interest-only loan. In fact, an interest-only loan, that is congruent with our GRE principle, financially free beats debt-free. I am not personally concerned that my principal balance stays the same year after year because, of course, inflation debases your equity for you. And with today's higher inflation, your principal repayment in real dollars right now is being diminished 8% every single year. So just like making an extra principal payment on your 30-year amortizing loan rarely makes any sense, then why make any principal payment at all if you've got the option not to? Typically with an interest-only loan, you have the flexibility also of making principal payments if you want, but you don't have to. So that's an important thing to understand. Now, if you're with me on that, Antonio, and that makes sense, there are a few downsides. Okay, so to have the privilege of having an interest-only loan, you might pay just a tad more in an interest rate because the bank knows that you're not building up their protective equity as quickly. In the past, I have paid an extra 0.25% interest rate in order to have this benefit of an interest-only loan. And understand as well, an interest-only loan, that might have a 30-year amortization, but it can have a balloon payment due in something like 10 years where that entire balance is due. So, of course, it doesn't actually amortize during that first 10 years, that interest-only period. Because, see, oftentimes banks, they don't want to let you get away with paying interest only for decades. So at the 10-year mark, they're going to call that balloon payment due. Now, when your balloon payment does come due in, say, 10 years, where you would owe that entire giant balance, in one lump sum, really, you've got three options at that point. You could pay the balloon out of pocket. Very few people do that. Or you could sell the property in order to get that balloon paid. Or you could refinance the property in order to get that balloon paid. But those are really your three big options once that balloon matures and hits. Pay out of pocket, sell, or refinance. So do understand that as a risk. Now, if you take any 10-year slice of real estate market values historically, rarely, if ever, are you going to find a slice where nominal values depreciate over 10 years. So those are some of the risks. And understand one irony of the interest-only loan. Even though it usually does benefit savvy borrowers, you're only getting paid 4 of the 5 ways as an interest-only borrower. The loan amortization piece goes away. But that amount, dollar for dollar, like I said, it increases your cash flow. That's why I like them. Now, paying close attention to your question, Antonio, you ask if the interest-only loan would be appropriate for a first-time investor. And in order to employ that as a first-time investor, I think you need to pass 3 tests in order to use an interest-only loan as a first-time investor. Okay, first of all, if you understand what I just said, you need to pass that test. Secondly, if you think you'd be responsible with the extra $300 in cash flow that the property generates with the interest-only loan. And then thirdly, as long as you're not stretching to buy the property. Okay, if the interest-only loan's $300 lower payment, like if that's the only way that you could qualify for the property, that's a good sign that you're stretching. So that's the interest-only loan and the benefits and the risks. Earlier in my real estate investing career, when I was principally focused on generating cash flow in order to quit my day job, I recognized how good interest-only loans are, such that I used one on just my second rental property that I ever owned. But if I ever could have heard myself talk to myself now, back then, I very well might have done it on my first one. But I did begin using them that soon on just my second property. Thanks for the question, Antonio. You're listening to Get Rich Education Podcast, episode 392. I've got lots more for you straight ahead today. We've got a lot of other great shows coming up in future weeks, including the return of Miracle Morning author Hal Elrod. Hal and I together talking about relationship building in real estate investing. That's a show that you're really going to like. If you like this show here, subscribe and tell a friend about it. There are really a lot of owner-occupant friends that you might know, primary residence dwellers, that would probably really want to hear what I've been talking about today with the home price surge and with interest-only loans. Hey, straight ahead, meet a GRE team member here for the first time. What he does is he gets on the phone or on Zoom with you to connect you with the right metro market and the exact income property address that's right for you. You're listening to Get Rich Education. Hey, my friend Damian Lupo informed me that checkbook IRAs have been made illegal by the U.S. tax court. If you have a checkbook IRA, your holdings are now disqualified with taxes and penalties up to 50%. But don't panic. Damian and the eQRP company can fix this. Those IRAs can be converted into eQRPs retroactive to last year, getting those tax deductions and reducing your taxable income. And this way, you can invest your 401k or IRA in real estate, Bitcoin, gold, and even your own business. So whether you're a full-time investor or retired or even a dentist with dozens of employees, if you're listening, you qualify, the eQRP works. It's a solution. You'll control your money, kill UBIT, and pay way less taxes. To learn more about this strategy and free up your retirement money, get the newest eQRP special report. Text GRE to 307-213-3475. That's text GRE to 307-213-3475. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to fourplexes. They're the number one lender for beginners and veterans. Start your pre-qualification, chat with President Shaley Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com.
Hi, this is Russell Gray, co-host of the Real Estate Guys radio show, and you're listening to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Here at GRE, we've had an investment counselor in-house for a while. So here to tell you who he is, how he helps you, and more, I'd like to welcome in Naresh Vissa.
Thanks a lot, Keith. Looking forward to having the discussion. Always a pleasure to talk to you.
You're an experienced real estate investor yourself. So tell us exactly how you do this and how you help our followers, whether you get on the phone or Zoom with the followers, and then how you help connect them with the markets and the properties and so on.
Well, let me first start with what you first started with, and that is I'm an experienced real estate investor. I'm not like as experienced as you, but I own, 8 properties now in 4 different markets or 4 different states. I've been involved in real estate investing since 2017. That's when I bought my first property. And I've learned a lot through the process. I've had some downs. I've had a lot of ups. I've made some mistakes. And a few years ago, I said, you know what? I want to share my knowledge with the world. Like kind of like you, I want to share my knowledge with the world. And I started coaching people. As you mentioned, I'm a real estate investment coach for Get Rich Education for GRE. And I help coach our listeners, people who are listening right now. I help coach them throughout and along their real estate investment journey. And the best part is GRE does not charge for this free service. Right. It's real estate investment coaching. So I highly recommend that people listening, if you don't know about this program yet, you can either email me directly, Naresh at getricheducation.com. That's Naresh, Naresh at getricheducation.com. Or I think we've sent out a few mailers if you're interested in the markets that I coach on. I mean, pretty much all of Alabama, Tennessee, like Memphis, Tennessee, all of Florida. We even have Wisconsin now. I've helped bring on new providers to provide inventory in Wisconsin, like Green Bay, Wisconsin, Wisconsin Rapids, Wisconsin, Ohio, like Cleveland, Ohio, Canton, Ohio, Akron, Ohio, Indianapolis, Indiana, South Bend, Indiana, Kansas City, Missouri, just a lot of new awesome inventory that we've gotten. So I'd love to share the inventory with our listeners and also help coach them throughout the process, whether it's financing, property management, negotiation, you name it.
Classically, those markets in the Midwest and South that have those high ratios of rent income in proportion to a low purchase price. So that's a lot of markets there. But of course, the problem has been this astounding dearth of inventory where, depending on what numbers you look at, we only have about 1/4 of the available housing supply that we need in the United States. But you were just letting me know earlier that there has been some more inventory that's come onto the market.
I should say inventory for Get Rich Education. Inventory as a whole for the United States is still a big, big problem.
Yeah.
But we were able to secure some partnerships with some providers and vendors and builders and flippers, wholesalers, you name it. And so we have a lot of, if you thought we didn't have much inventory at Get Rich Education before, multiply that by like 4 or 5. And I can tell you right now, as of this recording, we have over 50 properties available for sale. That's just how much inventory that we have, and all different types of inventory too. Previously, it was only new construction. Now we have new construction all over the country. We have cash only deals. We have short-term rental offers. We have overseas short-term rental type of offers. We have older properties that cash flow high. We have turnkey rehabs. We have as-is property. And then we also have multifamily. We have fourplexes, fiveplexes. This is just a really, really surprisingly a good time if you're a GRE listener because it's inventory galore and it's selling really fast too. You have to move so quickly because of just how hot the real estate market is.
Yeah, it has been hot. And maybe we can talk about some reasons for buying, and you can give me some feedback as to the reasons for people that want to buy in this market. Now, I sure know that I have my reasons, and that it's that one investment vehicle that pays me up to 5 ways at the same time. But I guess what I'm getting at, Naresh, is if you have the person that wants to buy property just because they heard their friend made a lot of money in real estate and they're all excited and they don't really have much foundational knowledge, I think something like that plays into FOMO, fear of missing out, and speculation. Or someone's in a rush to buy because they hear, well, I just think interest rates are going to go higher and prices are going to go higher. And while both those things probably are true and very well could be true, that's maybe a somewhat better reason than doing it because your buddy did it. But that kind of plays into more fear of missing out and speculation again. I really like to hear someone wants to buy property today for reasons like, well, for example, they know that they can still borrow at an interest rate that's substantially lower than inflation and exploit that delta and that arbitrage, or they know about the inflation triple crown, or that real estate pays 5 ways. And they've kind of got that longer term perspective on it that's not quite as emotional. Those are kind of the things I like to hear. So kind of with that context, you want to talk to us some more about why people are buying properties today?
First off, I don't want to repeat all the reasons that you've shared multiple times in the past in your YouTube videos, your YouTube channel, previous podcasts. I want to talk more about maybe some newer novel reasons of why people are investing or why you should invest. And by you, I mean the listener, not you personally, Keith, because I know you are a very active investor. The first thing that's not talked about enough is Wall Street. Wall Street has become the biggest landlord in the world. And Wall Street is essentially propping up the real estate market. And it doesn't look like they're showing any signs of pulling back, of selling to each other, because they're probably going to have to sell it to each other if they do pull back. They're not going to sell it to a mom and pop investor like me because they own so much. When I say Wall Street, I believe the firm that's the biggest landlord is the Blackstone Group, which is a huge private equity firm. But you also have the big banks who have in-house mortgage lending units or departments. So big banks, real estate private equity firms, real estate hedge funds. One of our providers we just brought on in Alabama, they have great relationships with these real estate hedge funds that just go in and buy 50 properties minimum at a time. You can see why the housing market is continuing to prop up. And what the average person doesn't know is that Wall Street is heavily, heavily behind this. So this does mean if Wall Street one day wakes up and says, hey, you know what? We're just going to unload everything. Like I said, they're not showing any signs of doing that. But if they did do that, then you would see a flood of inventory come on the market. And yeah, then we could expect prices to go down. But it doesn't look like that's going to happen anytime soon. The next thing that I want to mention about inflation. Look, the latest inflation statistics showed that 9%, we're looking at a 9% inflation rate. Like I said, I coach people, the GRE listeners, I help them with financing. Right now, as we speak, if you want a 30-year fixed rate, 20% down mortgage, we're looking at 5.5%. That's really the best that you're going to get, 5.5%. I won't be surprised if that goes up to closer to 6% because the Fed is raising rates rapidly. The free market, the rates are going up. But still, you're beating inflation, borrowing at a 6% interest rate compared to the 9% inflation rate. So it's still a really, really good time to get access to capital to borrow. Another reason, which you may have not talked about, but I think this should be talked about, another common question I get from students or from listeners is, should I create an LLC? Should I buy a property and put it in an LLC? Or should I have one LLC and put a bunch of properties in it? Look, regardless, the government has tried to help people, tried to help investors, real estate investors, has tried to help small business owners since 2008, really, since that financial crisis. And one program that the government came out with is this EIDL program, the Economic Disaster Relief Program, where they just gave people free money. So if you had real estate in an LLC, all you had to do was provide your LLC documentation, your latest tax return, and they just gave you free money. They just transferred it to your bank account and they say you don't even need to pay it back. This was in 2020. This year, 2022, they've expanded that program and they are offering SBA loans as a part of this EIDL at a 3.75% interest rate. So I actually personally, I'll share this. I got a $50,000 loan at a 3.75% interest rate on my LLC that houses a bunch of properties.
Great.
And that's, again, inflation's at 9%. And that right there is, I could use that on a down payment to buy a property, a new construction property. I mean, I can do whatever I want with it. So here's another example of how you can use your business savvy to acquire real estate, to earn appreciation, to get cash flow, and to take advantage of programs that just might pop up every few years where they're just handing away free money or giving out super low interest loans.
You touched on an awful lot there, including some good actionable tips. When it comes to the inflation piece, we've had CPI being reported quite high, 8% or more. A lot of people that really look at the way that that's calculated often say, oh, wait a second, look at the way that they were calculating it in the 1980s and how that's changed from then till now and how they've changed the basket of goods so that they can report a lower rate of inflation. A lot of economists come up with some sort of consensus that the real diminished purchasing power of the dollar could very well be something more like 15%. The more you research this, the more you're willing to believe a number like that. Well, if real inflation is 15%, and that's been about the appreciation rate of properties lately, then is real estate even highly priced at all? Or has it just been keeping up with inflation?
Right now, it's compared to what, right?
Yeah.
People are always going to compare things. So they're going to look at real estate. They're going to look at a piece of property today and say, oh, compared to 3 years ago, this is 100% greater. This is 100% of the purchase price 3 years ago. And mentally, they're going to say, oh, it's expensive. I missed out. You don't want to fall into that trap because I don't think the real estate market is going to crash. So many people are like, oh, I'm just going to wait for the crash. They told me that. Or I used to be one of those people in 2013, 2014. They said that in 2020. Now we're in 2022 and they've missed out, like I said, on 60% appreciation. The fundamentals, we talked about Wall Street, they're still very much in place. Do I think the real estate market will eventually cool? Absolutely. I don't think it will cool this year because of the geopolitical issues, because of the labor shortage, because of the supply chain crisis, because of just the demand for more housing, the number of people immigrating to the United States. We're still seeing a lot of immigrants. We're seeing refugees. We're seeing illegals. They all need housing. So the fundamentals are still very, very much there. I'm still bullish on real estate. I think rent's going to continue to go up. If real estate values go up, is rent keeping up? Yes, it is. It absolutely still is. If you look at the numbers, rents continue to go up. And I don't think rents will go down, really, maybe ever in our lifetimes. That rents are only going to continue to go up as more renters or as more people get priced out of the real estate market. I know people with very good jobs who make six figures in income, and they said, I'm priced out of this market because the type of house that I want, it's going to take me another 3-4 years to save up for the down payment and to purchase that type of house. Whereas 3 years ago, I could have afforded it. Those people are now renters too, and they're renting, new construction homes or nicer homes. Everybody needs a place to live at the end of the day. And I love real estate. I'm very pro real estate. The tax benefits are amazing. The appreciation is great. The cash flow is great. There are some pitfalls with real estate, and I coach people through that, especially if you buy an older property in a place like a Cleveland, Ohio, or a Memphis, Tennessee. You have to understand why the cash flow looks so high on paper. If you understand that, then you'll be ready for the surprises.
Tell us a bit more about those surprises, because a lot of people, especially newer investors, which are the ones that you most often deal with because they do have the most questions. Tell us about some of those pitfalls. We know about the upsides.
If you're a new investor and you want a smooth, seamless process or a smooth, seamless experience, and you have the capital, I would recommend a new construction property in an A-class neighborhood. And we have plenty of those in Alabama and Florida. That's what I would recommend. If you're a younger investor who has the money, but who is willing to take on a little more risk in the sense of maybe some evictions here and there, maybe some bad tenants, but the reward is if you don't have to deal with that, then you're getting very, very high cash flow. And these are kind of your Section 8 housing. These are your B- type of properties, your C+. When I say B-, I mean B- neighborhoods, C+ type of neighborhoods. And look, I own some new construction that are in A quality neighborhoods, but I also own some older properties that were built in the 90s that are in not so good neighborhoods that have performed extremely well. Or maybe I had to do one big rehab and upgrade some things and put a higher quality tenant in there. And I didn't have problems ever since. Some of these problems include your tenants losing their jobs. So like I had a tenant who worked at a hotel. I bought this property in 2017 and the tenant worked at a hotel. And initially when they came in as a tenant, I thought, oh, a hotel job is pretty stable. Like it's hard to get fired from a hotel. Well, pandemic comes and a bunch of hotel workers in 2020 were laid off or furloughed or whatever. And this tenant, I had to end up evicting because they couldn't pay their rent. And look, that's just a part of the process. You go through the evict, and the property manager handles all that. Somebody listening might be like, oh, I live in Florida. This property was in Memphis, Tennessee. No, I didn't fly over there and go after the tenant or anything.
Right.
I help coach people through the process so they don't even have to worry about this. They're going to have to spend some money, but you hire a good property manager and they take care of everything for you. And then you rehab the place. You put in some fixtures, make it look nice, and bring in a newer, higher quality tenant who you can stick in there and who is going to pay the rent and who is going to treat the property better. Those are some examples of some of the pitfalls that you're going to face when it comes to these older, high cash flowing homes. But look, many people, I know some Section 8 only investors were like, I love Section 8. Like I want only Section 8 tenants because the rent is guaranteed and my tenants just happen to work out pretty well. And I know other people who said, no more Section 8. I want to improve my property and get a higher quality tenant in there. So it just really depends. I've got a mixture of both. Like I said, I recommend if you're just starting out, if you're risk averse, stick with the newer constructions or the newer properties that are fully turnkey and rehab.
That could be a good piece of advice. A new construction property, you're not going to have to run into rehab problems. And oftentimes you can attract a better quality tenant as well. We talk about that rent income increasing, and rents are what some call downside sticky. Rents rarely go down. Even during the mortgage meltdown and housing crisis of about 2007 to 2010, my rents didn't go down, even though we were in a substantial recession. And then when you talk about the appreciation piece, we probably had something like 18 to 20% appreciation last year. At the end of last year, talking about this year, really making a prediction, I thought the appreciation would be about half of that, 9 to 10%. And so far here in Q2, I like how that's holding up. And the reason I think that appreciation will continue but slow is at some point we're going to have an affordability constraint. It's not really supply. It's not a glut of supply getting dumped on the market. I think that's really difficult to do. I don't see a BlackRock or anyone doing that. I don't see things getting constructed too quickly. It's a fairly inelastic condition with the supply. So it's really that affordability constraint, though I do continue to see appreciation, albeit just more slowly now. So Naresh, before I ask you if you have any last things to tell our audience, since a lot of them are going to be working directly with you on a phone call or a Zoom call as you help them out, if you want to connect with Naresh, you can do that at gremarketplace.com. Hopefully you've set up a login over there now where one login gives you access to all of our providers. And Naresh, again, his services are free. He's not working with all of our providers over there, but he is working with an increasing number of them. So do you have any last thoughts, Naresh? Anything a prospective buyer ought to know in this market today?
Yeah, well, like I said, the good news is we brought on some new partnerships, new providers, and we have something for everybody. Previously, it was just somewhat high price new constructions. Like I'm looking at our list of inventory right now. We have a new construction in Memphis, Tennessee, brand new. It's going to be complete next month, and it's selling for $153,000. There are people who said, I want a new construction. I want this, I want that, but I only have this much amount in down payment.
Yeah.
And I would say right now, we just can't help you because that's not what the market's dictating. But we're finding those partners. We're finding those opportunities where we have something for everybody. We have properties for as low as $83,000 in this market. We have a property in Akron, Ohio for $83,000. And it has a very, very high ROI, but you can probably guess why on paper it looks really good. Once you look at the pictures, you do some research on the neighborhood, And it's also not fully rehabbed. You'll understand why it is priced that low. But hey, there are some people. I talked to one guy who said, you know what, I'm okay maybe purchasing that and putting in $15,000 in renovation and rehab and then putting a tenant in. To me, it's still worth it if we can get this rent, which I think absolutely the rent that's listed is absolutely attainable. So the point that I'm making is we have properties, all types of properties for everybody. Like I mentioned in the beginning, short-term rentals, 4plexes, 5plexes, new constructions, older properties, Missouri, Indiana, Florida. I'll say this, Florida is the hotspot. Most of our calls coming in to me are, I want Florida. I either want a vacation home in Florida, or I want a short-term rental in Florida, or I want a rental property in Florida, or I just want to meet the governor of Florida because I love him so much. Florida is number one right now. It's like the hottest state that we're getting interest in.
Well, Naresh, this has been really helpful. You're surely giving people a lot of ideas about markets, properties. You're kind of giving people a reminder that oftentimes it's about the connections that you have in finding the right property in a market like this. And oftentimes it's about understanding what's going on behind the numbers. And that's something that you help them with. So it's been quite valuable. Naresh, it's been great having you here. Thanks so much for coming on to the show.
Thanks a lot, Keith. Always a pleasure.
Oh yeah, some good granular material from Naresh today. And by the way, the correct pronunciation of his name for when you're with him on the phone or Zoom is Naresh Vissa. I say it wrong sometimes. In today's environment of rising rents, not only does that increase rent, increase your cash flow, but it tends to give you a better quality tenant when you raise the rent as well. Naresh came on with us late last year because I kept hearing from listeners that I want to get started. And you do need to actually get started with some property yourself if you want these principles to provide you with any benefit in your life. Otherwise, this is just an interesting thing to listen to, and that's all that it would be. But buying real estate that you own directly, it's not just a quick point and click exercise. So Naresh helps you turn your best intentions into action. He helps you find exact property addresses and really leads you through the process. He helps see that you get pre-approved with the right mortgage loan company and matches you up with markets and providers, and even like signing the property management agreement in order to make this passive for you. Naresh coaches you, so big thanks to him today. To connect with him, if you haven't already, create an account at gremarketplace.com. You do that one time, and you've got access to all of our providers, whether you use his coaching or not. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.